Can you hear me? Ah, fantastic. Economists always like feedback, so that's fantastic. Not though earlier. Clive, thank you very much, and good morning, everybody. Just to warn you early on, we have 3 economists on stage. We're hoping another one will join us shortly, as well as a banker who knows all about economics. So what could possibly go wrong? Just as a scene setter, very briefly, what has gone wrong, of course, as we've heard earlier, is the textbook economics that perhaps we all learnt about. We've had, in hard macro terms, about 4 major global crises in the last 14 years or so, which means certainly based on the reserve managers we speak to, the elephants in the room currently, and they've been brought up, include inflation, the obvious one, geopolitics, but also how to pull the rug on what has been over a decade of ultra loose monetary policy. And just before I introduce the panel, just to throw some numbers at you very quickly, if I may. Firstly, because of the QE injection since 2008, which at about $20 trillion is more than a good night out, that's equivalent to sitting in the private sector pretty much the most part of 90% of US GDP or 115% of China's GDP equivalent. And it also means for central banks that about 3/4 of the world's total assets held by central banks has been built up in just 13 years as the debt pile has increased. And just final numbers, this debt pile that Lord Lamont referred to, of course, isn't just since COVID, it was building going into that. And as an indication, if we look at the UK, the US and core Euro area governments' debt to GDP numbers, back in 2019, prior to the worst of COVID, averaging about 77%. That was more than twice Japan's was when Japan limped into its lost decade in the mid-1990s. So all of these throw up many questions to me. Hopefully we'll get through most of them during our short panel. The questions that come to my mind, firstly, given all of this debt is in local currency, should we really keep the printing presses rolling? Secondly, if fiscal policy now has a greater role in keeping growth bubbling along, and John mentioned that we're not expected to grow at all in the UK this year, how real is quantitative tightening and higher interest rates? And we do have central banks making decisions this week and next. We now have the combination of higher inflation and war. Does that put a spanner in the works for central banks, or does it give added urgency for them to normalize? And what can we as investors, consumers, human beings, given the climate, parents, future parents, call it what you will, do to adjust and prepare? So I'm very good at asking the questions, but far cleverer people than I are sitting around me to answer them. And just to introduce the panel briefly, firstly, Sir Vince Cable, former Secretary of State for Business in the UK, and now author and visiting professor at the LSE. Antonio Correa, who's the practitioner on the panel, and his executive director of the Wimmer family. And also Lord Meghnad Desai, to your left, to my right, a member of the British House of Lords and author and academic, and hopefully Elliot will be with us shortly. But to kick off, first question, if I may, there's a heck of a lot of noise out there in terms of economic news. How do we look through that, panel? If I could ask each of you that question, how do you see the world through your lens? And perhaps, Sir Vince, if you don't mind, I could start with you. I say that because the LSE website says that you're currently mainly looking on the economic history of disasters. So I would ask you as a supplementary, how do you keep your spirits up, sir?
Yeah, I suppose the first thing we would say is it's a fairly obvious point that the key countries are at different stages of the inflation interest rate cycle. And you've got Japan, which is cutting interest rates below its target rate. The Chinese are desperately trying to offset the disastrous zero COVID policy and their slow deflation of their asset bubbles and property markets. But then in the United States, Europe, UK, we've got rapidly rising inflation and rising interest rates. So there's different stages of the cycle. Secondly, a point that Lord Lamont made earlier on, the difference between real and nominal interest rates. We've got very, very negative real interest rates, virtually close to zero, but rising nominal rates, policy rates, and long-term yields on bonds, along with high inflation. So, money is still very, very cheap. Thirdly, despite that, we've got a story of generally weak private investment, and this is partly a long-term story that some people have called secular stagnation, and also there's a short-term pickup in this in the last few months, as I'm sure you've seen. Bank lending is not growing in the US in real terms. It's falling in real terms quite strongly in the Eurozone, or certainly particularly in Southern Europe. And I guess one can attribute this partly to sort of extreme uncertainty. You know, we've had the pandemic, we've got the war, the energy crisis, possible geopolitical rifts, massive political uncertainty in the United States. I mean, all these actors in enormous weight on private investment, particularly fixed investment. And I think the final point I would make is that, you know, we are heading into minimum stagnation and probably recession, and certainly in the UK, US, and parts of the Eurozone, with interest rates rising to do with inflation. Governments are going to be under tremendous pressure to use their budget to stimulate the economy and offset rising unemployment, which will start to appear. So we then get into worries about, you know, government debt management. It's we've seen in Japan, you can keep this going more or less indefinitely because you've got local lenders, but in countries like the UK, where you have to rely on the kindness of strangers, there are potentially serious risks if the government takes too many liberties with public deficit and public debt.
Thank you, Sir Vince. And before passing perhaps to Antonio, could I ask you, you mentioned a very important point, which is we may be talking about rising interest rates, but they're moving from a very negative real rate to a slightly, well, less negative real rate. This is really a sign of the times. Does it worry you that we can't get growth going with such negative real rates, and what is needed to do so?
Well, that's what secular stagnation means, that you just can't energize private investment. So inevitably, people will look to the government to do it, and you know, understandably. We're back to the kind of debates that we had in the earlier part of the last decade when I was in the government, that you're desperately wanting to get public investment going, but it's actually, you're constantly looking over your shoulders and worrying about risk. And I guess one of the side effects of all this is what's going to happen in the United States, where you have, you know, rising interest rates, pressure to run bigger deficits. You're getting into a kind of Reagan-type problem, and money pouring into the dollar, possibly, you know, very strong dollar appreciation, and the effect all that is having on other countries whose debt's denominated in dollars.
And Antonio, same question to you. How do you see the world?
Yeah, first of all, good morning, and thank you very much for having me. Thank you for the presentation, also a banker that knows everything about the economy. I'm still learning, actually. That's the reason why also I come to this very interesting panel. Thanks for that. So in terms of, I'm from, is working? I can't. Yeah, I don't know. Sorry.
We will share.
Yeah. Thank you for that. Thank you for that. Yes, probably now it's working. So I'm from the independent private family office side. You know? So this is like the view that I bring, especially from my clients that are wealthy individuals, other family offices around Europe, around the globe. The concerns that you mentioned, and then also my colleagues here in the panel mentioned, such as inflation, geopolitics, the global debt rising. I would add sincerely, looks like that nobody is talking anymore. COVID is still here with us. I mean, if you see Asia, it just opened it up from a big lockdown. So this is something that is a concern, still be a concern for our clients, especially because we work globally, we invest globally, we have operation also in China, so that was like a big concern for us. And also it's a pretty exciting time for us as advisors, because I mean, I consider myself an advisor. to try to mitigate those kind of risks. And I'm gonna set up some points. So I work predominantly in private capitals, private markets, alternatives. Those are just a few setup that we can discuss that are asset classes that are a sort of edge with specifically with the inflation situation that we are living so far. So we can discuss much more about it.
Thank you. Thank you, Alex. Hello? Hello? I don't mind shouting. Let's see. Okay, thanks very much. Thank you. Hello, that's better. Thank you, Antonio. Let's go swiftly on to Lord, and we'll come back to the what do we do about this point. Lord Desai, how are you seeing the world, and are you happier than what the rest of the panel seem to be so far?
I'm always happy when the world is unhappy. Basically, we are living through another cycle, 50 years on, that we suffered in the 1970s. In 1970s, we had an oil price shock, and then for about 20 years, we lived through a very interesting, politically very explosive period, a lot of structural changes. But that was the first post-war experience of serious inflation. I mean, people here are too young, but I remember inflation rate of 22% in the 70s. Labour Party got into power and they froze academic salaries. So I can tell you it really hurt. But the point is that we had that thing from 1971 to about till Mrs. Thatcher retired, let's say, so 1991. And through that period, we lost faith in Keynesianism. We lost faith in a single, one nation government. And we really did a lot of restructuring of the welfare state, restructuring of the political system. And at the end of it, the idea that market works triumphed in economics. Thatcher, Reagan, and Cole were the three people who basically changed our whole structure. But what most people did not notice is that inflation did not come down because central bankers were very intelligent. It was because people took their money out of industries in the West and put it into Asia. It was not a monetarist triumph, it was a Marxist triumph. Marx had predicted capital will go anywhere to make profit without regard to borders. And so basically the industrialization of Asia, Korea, Taiwan, China, and lastly China, but all those countries which are cheap labor, manufacturers went there. They abandoned, the Midwest of United States. UK has more or less lost manufacturing. Now, this time around, it's not clear where they will go. Because this time around, we have a stagflation. And the good news is that I can tell you stagflation is going to last at least about 10 years, sorry to say. But how the world will cope with this crisis in which there will be persistent inflation and a long recession. But where will the escape be? I mean, you all want to make wealth. And since I have never made wealth, I better find out how to advise you about that. My view is that right now, the key dynamic sector is technology, because technology is getting cheaper. One of the few things which is getting cheaper are smartphones. The other day there was a headline that Google has found a sentient artificial intelligence device. Now, what we'll see is more and more people changing their labor market behavior and more machines replacing people. There are already ideas that in the British agriculture, we need robots to do the fruit picking. And Charles Goodhart has this very interesting long-term vision on demographics, which is basically that labor market behavior is going to change, and it's already changed. What's happened to at least my generation, people who got into the inflation cycle early and put it into sort of real estate and all that, they have enough money not to work. They don't really have to kill themselves to work. And so they go to 4-day week or whatever it is. It's the younger people who will have to be the gig market workers. They will be at the technological end of business and so on. So it is going to be a very, very difficult situation. And it will be, the new generation will have to find out where they're going to survive and make money, because we have lived through, we lived through about from 1939 to about 19 less than 1989. Let's not go about 50 years of inflation. Then we have an off and on inflation not. What the central banks have done is they have made the rich richer. Which is very interesting. When there's inflation and workers are demanding high wages, you batten down on them. But if the rich are in trouble, you buy their assets and make them richer. So basically, central banks have really been a device for increasing inequality of income. They can't get inflation down. Nothing to do with them. But they are a redistributive agency. Now, so I don't know how long people will tolerate this kind of behavior, because it's a central banks who drove the interest rates down to enrich the rich. They were not fighting inflation, I can tell you that. Because as an anti-monetarist all my life, I don't think they can. But they get the credit. Interestingly, I don't know this time around how we are going to tackle inflation. What other sectors, like in the 70s we did for capital to go and invest in. And I think it would be mostly technology, artificial intelligence, digital technology, and things like that, which don't require too much labor, but only skilled labor. And so we don't have the Phillips curve danger there. And I think if that happens as I predict, we will have conquered inflation, but the world economy will look a very, very different place in another 10, 15 years.
Magna, thank you for that. You mentioned the 1970s, which I not quite remember, but Clive told me all about it. One thing, obviously, that was important there was high level of public ownership, centralized pay bargaining, and unionization. Given the cost of living crisis, as is reported, and tight labor markets, at least in the US, can you foresee any of those elements coming back over whatever time period?
No, the one thing I will peddle is that the welfare state, as we established, is extremely inefficient and very expensive. But if one were to really redesign it in terms of, say, citizens' income, which is kind of my favorite thing. I mean, you don't need all this, universal credit and all that. It's really, so don't worry about public ownership of means of production. That's old hat. Just make entitlement of citizens to a certain basic income. That will sustain the economy, and it's affordable, because basically 2008 proved is anything is affordable. There's no such thing as, the future generations would be landed with debt. All that stuff is gone. In 2008, what we discovered is if the rich need money because they've just gone bankrupt, you print money. And the responsible central banks went out and printed money like there was no tomorrow, and they're still printing it. So printing money is not a problem. It's who it goes to is a problem. Now, I think what will happen, the one big change which will happen, as my one prediction, that citizens will demand that they also have a part in that kind of bonanza. Because, and the state and the governments will like it because it will make life much easier. Because if you're just handing people out money without any questions asked, that simplifies administration. I can simplify the entire welfare state in no time. So I think if we adopt that sort of attitude, then we will get a much better. Yes, the state will be bigger, but it will not be inefficient like in public ownership of means of production. Let means of production be owned privately because that's where innovativeness and entrepreneurship is. Let the money go to people because they can then spend it. See, if you give money to people, they're going to spend it, so the money will come back. Money doesn't. They're not going to hold money. So all this, superstitions about printing money and all that is rubbish. You just print money and get on with it.
Thank you for that. I'm conscious that we may have only 15 minutes left in what is a fairly tight program. So I'm going to bundle two major subjects together, if I may, and again go to Sir Vince first, if that's okay. And that is, firstly, there's one big difference now between, let's say, the 70s, previous chapters, has been economic noise, I guess, social media, etc. Everything's reported. Things are more transparent, at least with central banks. What we're seeing, is this a new paradigm for us? In general, or is this sharpening the forces that were already there? And linking that, because I think there is a link, could you also give your comments, please, on no small subject, which is the implications of the tragic war to the east currently, and also what it may mean for international relations elsewhere, two very small subjects. So, Vince, over to you first, if you could.
Well, what has fundamentally changed since the 1970s is the rise of China, which, in some measures, is the biggest economy in the world in purchasing power parity terms. And we now got the prospect opening up of this, what some people are calling the Great Split. And for wealth managers, this is an interesting question because, after 30, 40 years of asking, the Chinese have just down because of geopolitical factors. I think there's several elements to this. I mean, one is the relatively short-term concern that the Ukraine war might provide a precedent for activity in Taiwan. I rather downplay this, actually, because there's no evidence that the Chinese are preparing actively for a conflict. They do a lot of shadowboxing, but not actually doing it. They've got no recent military experience. The last time they fought a war was almost half a century ago in Vietnam, and they lost. There's a sort of buzzing of airspace, but very little evidence that they're actually planning an invasion anytime soon. And it would be horrendously difficult anyway, and invading a country across 100 miles of sea. It's sort of Normandy landings cubed. But people who are the military people who are looking at this think there is a possible conflict situation developing maybe in 4 or 5 years' time, but certainly not imminent. I think what has really given rise to this talk of the Great Split and geopolitical conflict is actually the underlying economics. I mean, China's arguably now bigger than the United States simply in terms of economic size or parity, I mean, depending on how you measure it. This has been achieved with 4 times the population, in other words, a quarter of the per capita income. So if the Chinese were to move up to, say, half American living standards, which sort of roughly Romanian levels, which is perfectly plausible and entirely understandable objective, they would then have an economy twice as big as the United States. And it's not just big, it's increasingly sophisticated, and their technology is arguably world beating in 5G, and increasingly in electric vehicles and a whole lot of other sectors. And our American friends are, quite seriously alarmed. I mean, they are being literally overtaken. Now, part of the answer to this is, well, actually, the Chinese economy's got quite a lot of problems. Demographic, bad management of asset markets, misallocation of capital, and so on. So you don't need to get alarmed. But Nonetheless, there is what is creeping in and what is very dangerous, and it's happening both in China and in America, is this sort of zero-sum view of the world. You know, that if the Chinese advance, it must be at the expense of the United States, and the Chinese becoming increasingly obsessed by the idea that the Americans are trying to stop them achieving the kind of levels of development and standing in the world that they would regard as their natural right and a product of their achievements over the years. And this is producing a dangerous standoff. And we're seeing in all kind of small ways, you know, the disentangling of supply chains, threats to Chinese companies investing in Western capital markets, threats both in China and abroad. Alarms being raised about the amount of portfolio investment going into China and putting some sort of curb on it. And you're getting this sort of security mindset setting in both the US and China, and it sort of feeds on itself. So the irony at the end of the day is that, you know, as wealth managers, you've now got an opportunity to invest in this great new superpower with phenomenal opportunities and what a whole new generation of high-tech Chinese companies backed by the state being launched in Shenzhen and Shanghai and promising very high returns. You've got this wonderful offer on a platter, but the high geopolitical risk discount that you've got to then apply to these investments, there's a real dilemma opening.
So geopolitics certainly in play. I'm not sure if it's any more or less than it has been in previous decades. But Magnan, could I ask you about when things settle down, is this part of a move towards a less globalized world?
Yeah, you see, in a sense, globalization also goes in cycles. I'm kind of one of the last believers in long cycles. You know, we had globalizations at the turn of the middle 19th and 20th century, which was broken by the First World War. And then it didn't really come back till much, much later, sort of in our lifetime. Remember the end of history and all that. So it came back. Now, I think the thing is, it depends upon whether regional specialization will still go on, or we will have such a technology that most people will be able to make things very much on their own. You know, sort of globalization is needed when you have raw materials in one place and factories in another place, things like that. And it also requires, you know, the slow-moving boats and trucks and railroads are much more vital to globalization than we think. If we think of globalization as a fast speed thing, yes, people may go in airplanes, but goods go by trains and so on. So it would need a global order, global protective order, which currently mainly America spends a lot of money on to maintain the sea lanes and all that sort of stuff. China has built these absolutely mad railways from Beijing to London and all that. Now, that kind of stuff may not be necessary anymore because people will have technologies which will save them on having to import raw materials and things like that. You see, globalization started because the Japanese invented this idea that although they had no coal and no iron, they could still make steel. So they invented just-in-time inventories and globalization and so on. They did that. But if you have, you know, most other countries will have access to these sorts of raw materials, or we will be saving the raw materials. And that will mean that globalization will not be economically necessary, except for passenger travel. Sorry, that's kind of my tuppenny worth.
Absolutely, and thank you for that. I guess two things that flow from that. One is that if we are looking at a less globalized world over the whatever term, does that then give us the competition that Lord Lamont
Let me just add one thing. I did predict deglobalization 20 years ago, but at that stage I thought that the problem would be countries would quarrel about sharing the gains of globalization, and they'll get into conflict. Europe always gets into conflict every 30, 40 years. So that may not happen. If that doesn't happen, then I don't see why there should be any need for wars and things like that.
I would like to add a point that was pretty interesting on this deglobalization situation, and actually what is more relevant that you just mentioned, that is on the role of the wealth manager or the advisor on the specialization aspect, the expertise. I think that's very relevant. I don't think I will not enter on the point that if we are going to a deglobalized world, because I'm not so sure about it yet. We are in a situation on hold right now in the last 2-3 years, 5 years right now. But yes, what we are seeing from our clients, they want to hire us for expertise. Expertise means two main things. One on geographic area. So we are closing down the markets where we go. So we are focusing on markets where we have a very strong hands-on experience. What that means with that, a senior team that be living there, be working there. So we became a sort of, I go back to my very beginning, a mitigator of risks for the clients. And second things on the asset classes. So we are closing down the spectrum to niche asset classes, such as the one that I mentioned at the very beginning, alternatives, private market, that for us are very relevant, where actually we can find better yields for the clients in this macro environment. So those are the 2 points that I would like to add what my colleagues mentioned.
So you're passing the baton around. Antonio, you raised a couple of very important points there. Just two things, if I can throw this back to you, not throw it literally, but hand it back to you, which is therefore, has, in terms of the macro implications from what's happening in Ukraine, has that had an impact on clients' views as to reserves potentially being frozen in a country as a policy weapon in any form? And the second thing, I guess, if there is some sort of deglobalization process, is that a reversal of what we saw during COVID, which is a rotation back towards services from goods, and does that matter for what you do?
Okay, on the first point, we are a multifamily office, so different kind of clientele in terms of passports. Yes, we have few Russians. We have few of them that are the one sanctioned. It's not very easy to talk about it, sincerely. So we are putting the situation a little bit on hold because we are deciding the best way to do it. In terms of specifically if those sanctions or the Ukraine war been affecting our client investments, not really, because we don't have any exposure in that specific geographic area. If we are talking about much more broadly, because then we have to enter in oil and gas. Yes, we have exposure very strongly in mining, commodity, but not that much in oil and gas, because we made some kind of decision a few years ago to move to some asset classes in the commodity sphere, agribusiness that we know more, such as gold, precious metals. We've been doing a lot of activities and investments for our clients in the energy commodity side, but linked to lithium and cobalt, because we have a green agenda in-house. So those few points. The second question was, sorry, Neil?
In terms of the sector rotation towards services.
Well, as I mentioned, my expertise is very much in alternatives. So what that means with that, it's private markets, private equity, private credit, agribusiness, mining, infrastructure, real estate. So we stay actually very sticky to this one because those asset classes actually are very relevant inflation hedge. We are talking about the inflation. We are talking about the infrastructure. We are talking about the real estate with income generation, no? That are most of them linked to inflation, indexed to inflation. Mining, gold, no? We have during the last 3 years, that is like the period of the pandemic. Actually, we've been managing much more the portfolio, balancing and reducing risks. We didn't do any investment during the last. Also, another point that actually the previous panelist, the Rockefeller Family Office mentioned that is very relevant. We are a patient capital. What that means with that? Long-term investments. So during those very high crisis moments, the most important things at the end of the day is to brief, to stress test, and try to avoid a scary movement that can affect the portfolio.
Just add one or two quick points if I can. I think one of the hidden consequences of the Ukraine war and the sanctions is it's raised all kind of questions about private property and the rule of law. Whatever we personally feel about seizing the assets of oligarchs and whatever we do with the cash that comes from it, it has sown doubt in a lot of parts of the world that their assets are secure. I recently did an interview on Chinese television, which was about everything, but actually $3 trillion, almost all their foreign exchange reserves are in dollars. And the second, which is linked to that, is that the technique that we in the West are using to sanction Russia, which is stopping payments, and the use of SWIFT system. I mean, this has always been assumed to be like a kind of lubricant that just makes the economy work and it's uncontroversial. But if you use it to stop payments on political grounds, the whole international financial system potentially grinds to a halt, which is why you've had, perhaps rather dodgy suggestions. The Saudis now translating all their trade with China into renminbi denomination because they no longer trust a dollar-based system, and this infection could start to spread. And just a final point, just a separate point entirely about this shift from goods to services, I think is important. I mean, the one thing that governments can do if they're trying to offset some of the negatives around globalization is to stop the movement of people. I mean, governments can do that. It's much easier to stop people moving than finance moving. And of course, service trade depends to a very large extent on free movement of labor. And we're already seeing this in the UK, where particular labor markets are sort of drying up because of the lack of flexibility in the immigration system.
Thank you. That raises so many interesting points. I'm conscious we're coming up towards time, and we don't want to deprive anybody of their coffee and also the chance to ask these guys some more questions. So I'm just going to end with offer the guys one more question. You can have question one or two, take your pick, or indeed have both. One actually was on currencies in terms of what are potentially, are there any other new safe havens out there? You mentioned, Sabins, potentially the renminbi, which is in line with some of the findings that we've had when we speak to our reserve managers. And the second one is, do you ever think we'll get back to normal? And by that, what I mean is this romantic view of bank policy rates being some way above inflation and central banks doing monetary policy only. Who'd like to go first?
Yeah. I mean, I want to make one comment on what Vince said. I think basically, while financial sanctions against Russia seem to be morally justified, they're actually a terrible breach of trust. And I think this is what will deglobalize the world. What will deglobalize the world, the Chinese have already developed their own payment system, which may not be as efficient as SWIFT, but it will become efficient very soon. I mean, this is not difficult. And this is where I think I would really say that if I use a dollar-based currency, all other currencies are dollar-based, and if I cannot be sure that I'll be able to cash my check or do my money transfer, then I'll have to find another monetary system. I mean, this is absolute. I deplore what Russia is doing in Ukraine, but what Americans are doing, much worse than SWIFT system. Americans have grabbed all the Afghan reserves. I don't know if people know about this, on the idea that there's a case outstanding against Al Qaeda in New York courts for 9/11. In lieu of that, the Americans have frozen all the Afghan foreign exchange reserves which were there. I think that's absolutely most outrageous thing I can imagine, because that has caused a famine in Afghanistan. And very few people know about this. Now, the Taliban were created by the Americans. Americans created the Taliban. I'm old enough to remember that in the 1990s, gave them drugs and guns. They sold the drugs to buy some more guns. But this is to fight the Russians in the 1990s. So they created the Taliban. And so now they're punishing the Taliban because they lost against the Taliban, but taking their money away. It's Afghan money. It is not American money. It just happens to be banked in New York. And I think it's outrageous that in the dollar system that is allowed, and nobody is protesting. It's absolutely terrible. Anyway, that's my deglobalization message. Get out of this system.
Well, just the one question which you asked, which I will answer, which is about the central banks and their multifarious roles that are growing. And I really do think that this spreading of the agenda is actually really rather dangerous and foolish and misguided. I mean, I made the speech in the House of Commons in defense of Gordon Brown's establishment of the Independent Monetary Policy Committee in 1997, which in turn built on the work of Nominal and others to establish central banks as credible anti-inflation organizations with genuine independence. And I think spreading their remit into climate change and inequality is perverse. I mean, I'm a very strong believer in zero carbon economy, but you've got to do the right tax and investment policies to do it. I worry greatly about inequality, but it's up to social democratic politicians like me to argue the case for taxing property or inheritance or whatever it is. You can't smuggle this through under monetary policy. So this, central banks trying to do everything is one of the more dangerous features of the modern world we should be retreating from.
Well, on the globalization side, I think that also for us it's very relevant that we are closing down a little bit the spectrum of the markets where we are going. It's very focused today, the market close to us that we know better, such as Europe, UK. On the macro side, on the central banks, it's a lovely discussion that's going to take like much more than 45 minutes an hour. The numbers looks like I read yesterday from the chief economist of Goldman Sachs that the expectation to inflation go down to some kind of normality. What that means with that, we don't know yet, because till a few years ago was 2%. Now we are going to arrive there. Nobody knows concretely, and it's 18 months, 2 years, something like that. It's a very big point for us. Again, we stay much more sticked in the expertise that we have in the market that we know, And again, we invest in asset classes that are inflation hedge. So this is like for us a sort of cure.
Thanks, Antonio, and thanks, everybody. I'm going to, if I may, reserve audience questions until the coffee break, because otherwise I'll be told off by Sasha and my other colleagues for yet again showing an economist can't stick to time deadlines. But hardest bit of moderating, really, apart from passing the baton back and forth, is to try to sum up 3 quick points. First one, as we move at whatever speed from negative real rates, fiscal policy seems to have the opportunity for a greater role. If that is used to expand the economy, the question I have is how real, therefore, is the prospect for quantitative tightening, selling the assets back? Secondly, one of our esteemed members said the state will be more efficient this time, which is potentially just as well if we are heading towards a chipping away at that globalization, which is probably a crack in the ice rather than a cliff edge event. And in terms of how to play it, and thanks to Antonio for being the practitioner here, localized expertise, risk management obviously important in this environment, and I guess long-term strategy over short-term tactics, with inflation hedging being the obvious one. Before I wrap up, I'd like to, if I may, obviously thank the panel, but mention, in addition to his obvious economics and political expertise, one of our panelists fulfilled a lifetime's ambition back in 2010, and did rather well on the BBC's TV program Strictly Come Dancing, getting a 10 out of 10 maximum vote from Len, a 10 from Len. I won't mention who he is because he's too modest, but I say that only because I personally would like to give our panelists 10 out of 10. To you as well, and thanks for listening. See you for